About Association of Indian Management Schools? It's a 34-year-old networking body of B schools in India, having a membership of about 600 top management institutions. AIMS focuses on professionalization of management education, protects interests of B schools, represents management institutions at national and international forums, financially supports members in academic events, funds research projects on management, disseminates management-related knowledge through its annual Management Education Convention, conferences, seminars, roundtables and workshops, organizes free weekly webinars on knowledge sharing and inspiring young leaders sessions for management faculty and students, supports B schools in admissions through Atma, AIMS test for management admissions. Visit https://atmaims.com for more details. Publishes a biannual AIMS Journal of Management. Visit https://aimsjournal.com for more details. Circulates a quarterly e-newsletter on AIMS activities. Conducts workshops on case writing. Encourages AIMS members to be part of decision-making processes as members of chapter management committees and the executive board. Encourages students' participation in free weekly quiz competitions by providing support to interested institutions. Facilitates networking and interaction among B schools. Why would you like to remain a non-member of AIMS? Pay a very low one-time membership fee and enjoy many lifetime benefits. Visit https://aims.org.in for more details.
This is my privilege to have in the series of talks on various important themes on the platform of AIMS. And here is our guest, Dr. Anilkumar, who has extensive experience not only as an academician and being an engineer in terms of his qualification, and also done his MBA and various professional courses, and also his doctorate, especially in the area of financial derivatives. And further to that, he has been in the field of consultant and also as a sub-broker to NSE. He has been the investment field for many years, and we rarely see academicians with a blend of experience in their trading, stock market trading. And Anil Garag is an exception in this regard, and I am proud to say that he was my student as a postdoctoral, a doctoral student at Goa University. And he has been working with various institutions. I can't take time to list out all the companies where he's working, but essentially he was interested in startup companies and most importantly in wealth management, investment management, and also providing guidance in terms of investment in IPOs and FPOs and so on. And he is also blessed with the expertise of his other partner, with Mrs., who was also in the field. And that's how both of them are in the field of especially the stock market investment. And he is the one, I thought, the right person to speak on the current trend, what is happening, and we always talk about disruption. And again, we have seen disruption of the uptrend in the stock market. And as an investment advisor, we always speak that we should always have to have a long-term view in terms of our investment. But unfortunately, the short-term trends that trigger the market within no time of appreciation and depreciation create a kind of chaos in the market. I think we need to be very clear that if you are a true investor, you have to be a long term, medium term to long term. You cannot work for short term. If you want to work for short term, yes, you have to take a huge risk, which will find no boundaries, either upwards or downwards. So that is what it is. And now in the present stock market conditions, and especially with the winning of the 5 state results and the government success, and then there was a boost in the market trend. But subsequently, again with international trends, the markets started rebounding. Garag is going to give you a direction of explaining you that one should not go by the what I would say by the mob experience, where only the bulls are running and where the bears are running. So one should have a cautious approach. And Anil Garag, with his expertise as an investment advisor and stock market broker with NSC, is going to give us the tips as the investment advisor and wealth management, most importantly, because he's focusing also in terms of mutual fund investment and so on. So with this, Anil Garag is a very vast experience in the field of investment and especially financial derivatives. So he did his doctorate in financial derivatives. So he is both in good in terms of financial derivatives as well as the stocks. And now with this brief introduction of Anil Garag, now I would request Anil Garag to take over the session. And I'm sure that all of you would enjoy. By now you must have already seen that there are directions which are already given by our AIMS office, that the flow of that session would be 40 minutes presentation, followed by 10 to 15 minutes question and answer sessions. And those who want to put the questions, you have to essentially put in the chat box, which is already informed to you. One. Second thing is the last 15 minutes of the session, that is from 3:45 to 4 o'clock, you have to give your feedback. You have to fill the feedback form. If you don't fill the feedback form, then you will not get this certificate. This is to ensure. And then you should not mute your online connection. That's very important. We want to ensure that you are participating in that. So with this briefing, I request and I congratulate all of you who have joined for this Zoom meeting as well as the YouTube viewers. Thank you very much. And now I request Anil Garag to take over the session. Over to you, Anil.
Thank you very much, sir. It's a great honor being introduced by your teacher. It's really overwhelming for being introduced by my own teacher. Very good afternoon to all of you. Let's look at what drives the stock markets, and let's see what are the emerging trends, what is expected out of these markets in the maybe in the medium term. Let's not talk in terms of long term or short term. Let's what I thought was we'll talk about the medium term. Well, what drives the stock market? The things that drive the stock market are basically, you ask anybody, you talk to people on tech, you look at people talking on TV, or you talk to people who are practicing. First thing that they talk about is what drives the stock market. They say foreign institutional investors, because they have the money and they will drive the market. Maybe we will look at it, whether they really drive the market or whether they are only riding the crest or the trough. We'll look at it. Another very important entity is the domestic institutional investors, the mutual funds, the financial institutions, the life insurance companies, etc. So these are the ones which are driving the markets. Then, of course, large HNIs are there these days. There are huge number of high net worth individuals. We call them what? Big sharks and shark portfolios, what all and what not. These people also drive the market in their own way. But the biggest driver of the stock market in India today is the retail investors. Because if you look at the growth of retail investors in the last 5-6 years, the number of investors have doubled. So that's a phenomenal increase in the number of investors. That's as far as what entities drive the market. Now, apart from the entities, we shall also look at what factors drive the market. One factor that drives the market very, very strongly is the economic growth, whether the country is growing or not growing. That is one of the first things that comes to mind. Secondly, what is the flow of money in the market? So monetary policy of the government, of the RBI. Then the third thing that drives the market or drives people into the market or outside the market is the regulatory environment. When regulatory environments are loose, when regulatory environment is not so strict, then you find some kinds of investors. And when the environment is very good, you find different kinds of investors. So if you look at our country from, let's say, early 90s to 2010, 11, 12, even up to 2014, I would say, we were evolving. Our regulations were evolving. We had SEBI. We started SEBI in 91, but the regulations kept on evolving. And as long as we were dependent upon the participatory notes, where it is not necessary to tell where the money is coming from, it is not necessary to have KYC, the markets were behaving differently. And once these regulations are in place now, you find that more pension funds, more organized investors, more foreign mutual funds are getting into the country. And people are not choosing the foreign portfolio investment in the sense the portfolio investment route to get into the country now. So slowly things are changing towards more organized market players, more organized foreign institutional investors, and that is a testimony to how our regulatory environment has changed. Then one of the cornerstones of the driver of the market is the trading and settlement system. We had a batch settlement, we had T+2, now we have T+1, and God knows, we may start instant trading settlements too in some time to come. And of course, all this happens only if you have political stability and continuity of policies. Then we will look at whether there are investable opportunities in the country. We'll also talk a little bit about interest rates and inflation. So these are all the things that I will be talking about in the next 30 minutes or so, on what drivers are these and how these drivers affect the market. And then we will also look at maybe a small forecasting kind of a thing. We may not do a specific forecast, but we may look at what is expected out of the markets, what is expected out of this investment environment that we are in. That we will do at the end of the session. So we'll start with the first piece of information that
You are sitting here.
Pardon?
Yeah. No, nothing. Sorry.
Okay. Okay. The first piece of information that people look at when they start looking at where, how the market is being driven by foreign institutional investors and domestic institutional investors is how much money they have been putting in for the last year or so. So I have some data here from moneycontrol.com which says this is as of yesterday. So as of yesterday, 1,85 crore 846 crore rupees has been pumped into the market by foreign institutional investors, which is phenomenal. But more than that, I would like to bring to your notice the amount of money that has been put in by the domestic institutional investors, and that is around 63,000 crores. 1,85,000 crores coming from outside is one aspect of it, but 63,000 crores being invested by domestic institutional investors means this is the money of the retail investors. This is the money of the investors from India. And one of the biggest conduits of this investment is the mutual fund investments. And you find here that the kind of money that is being put in by Indian investors is phenomenal. You can see April 2023, the Indian investors had put in only 475 crores, whereas by the month of December, we have already put in, Indian investors have already put in 15,000 crores in a single month. So that's the kind of money that is getting into the markets. Important thing to note is also that foreign institutional investors withdrew money sometimes in September and October 2023. Nevertheless, the Indians kept on pumping money into the market. And the result is for all to see, where you have the Indian stock markets at an all-time high now. We are celebrating huge, huge wins in the market for everybody. So these statistics basically tell us that what is the power of the FIIs and DIIs in the market. Obviously, there was a time when for an Indian investment of around 500 crores, FIIs used to put in 15,000 crores. So that was 30 times of the money that Indians put in. But in December, if you see, the foreigners are putting in 3 times more than what Indians are putting in. So that means in 10 months' time, we have already started deciding, or we have already started dictating how our markets should behave. And this is a big win for the markets. So that means we will not be swayed by foreign investors, because see, basically, when you depend on foreign institutional investors would be interested in coming in, getting into the market and getting out. So we also call it hot money, whereas Indian investors are not hot money. They are the money that stays in the country. So that makes a big difference. So this is regarding the foreign FIIs and DIIs. Now let's look at some vital statistics of where our country is poised right now, so that we get an idea on whether it is imperative to invest in the country or not. See, when we teach this subject called security analysis, portfolio management, we in all MBA institutes, usually they teach this subject and they call it EIC analysis, economy, industry, company analysis for investments. So what comes up first is the economy. So let's look at where our economy is standing right now. You can see that India is the GDP of India is around 3,385 trillion billion dollars. So that is $3.385 trillion dollars. Compared to, of course, this is the India is in the 1, 2, 3, 4, 5, 6th position in the world, and but if you compare it to the United States of America or China, you will find that we are much smaller. We are 5 times smaller than China, and maybe 1/5 of China, that is, or maybe something like 1/8 of United States. But that's okay. I think we are a growing economy. We will continue to grow. If you look at the growth in GDP, this is the last quarter's growth, and in the last quarter, United States has grown rapidly. This growth also shows us one more thing, that is, if last quarter it has grown by 5.2% and India has grown by 1.9%, that's the reason why money moved in from October, November. In October, November, a lot of money was withdrawn from the Indian markets, went into the US markets. So FIIs basically are pulled out money from the markets when things were going better in the US. If you look at the other countries, you'll find that China has been is growing at 1.3% last quarter. Euro area has been shrinking. Japan has been shrinking. Germany has been shrinking. So if you just look at these numbers, you find that there are the investment opportunities are in United States, China, India, and maybe a little bit somewhere in Italy, Brazil, Australia, where they have a small, where they have very small growth. So, see, money always hunts growth, and based on that, India seems to be the second. India seems to have the second highest growth rate in the world. And another thing that we also would look for, or the investors would be looking at, is interest rates. It's like water, water settles down in a place where there is more depth. So money also goes to a place, money gets attracted to a place where the interest rates are higher. But that does not mean that it will go to Russia or Brazil, because there are other aspects to it. If all things are equal, then money would get attracted to the place where you get the best interest rate. So you can see here that our real interest rate is, India's real interest rate is working out to 0.95%. That is the interest rate minus the inflation rate. United States real interest rate is working out to be 2.4%. China, of course, is also working out to be something like 3.95%. Euro area is working out to be something like 2.1%. That is the difference between interest rates and inflation rates. So money gets attracted to places where the real interest rate is more. Nobody cares about what's the inflation, what is the interest rate. In individualistic terms, but in unique terms, but people look at whether what is the difference between interest rate and inflation rate, and therefore they look at the real interest rate. We have a single-digit joblessness rate as of now, 7.10, which happens to be on a very, very high side. But that done in India, you don't know. Actually, Indian jobless rate is a little bit of a gray area, because most of the employment in India is in unorganized sector, in a sector where provident fund, ESI, and things like that don't work, and therefore there is no, there's no authentic record of what is the employment rate or unemployment rate as such. But nevertheless, it's an estimated amount of 7.1%. One pain point for the country is that our deficit is 6.44%, minus 6.4%. That's the biggest pain point. Our debt to GDP ratio is not that bad at all. 89% is a debt. That's not such an alarming thing. There are other countries which have more than 100% debt to GDP. So we are not very conservative, but we are not very aggressive too. So that said, let's look at our current account. This is something which will make us understand what happens to the currency rates. Our current account is in deficit, just like the United States of America. You will find that even though our current account deficit is around 0.26%, we have been able to manage it much better, and since we have been able to keep it at that level for a long time, I think Indian economy is poised for good times ahead. Of course, population is one thing that India excels in, around 137 crore people in India. That's a huge workforce. There are, if it is 137 crore people, then it is 274 crore hands, and so that's the biggest democratic dividend that we have. So these are some of the vital statistics to look at whether India is a good country to invest in or not. The huge population in the country also means that there's a huge middle class in the country, and this middle class is as big as the United States of America. That's the biggest plus point. Well, where do you think we are expected to, how do you think we are expected to grow? OECD Economic Outlook November 2023 has done some projections. India is expected to grow at 6.1% in 2024, and it is expected to grow at the rate of 6.5% in 2025. You can see the other countries there. So the biggest opportunity lies in India. India's growth rate of 6.1%, expected growth in 6.1%, and expected growth of 6.5%. This is done by the OECD Economic Outlook. That itself tells us a great story about the upside in the markets, the opportunity in the markets. So that's the projected GDP growth for you. You'll also find that the other countries like China and United States, who we are more interested in, are growing at a much slower rate. But an $18 trillion economy like China growing at 4% would be actually a big jump than 3 trillion economy growing at 6%. So obviously, Chinese economy in absolute terms is going to become much bigger, and it's going to add much bigger GDP to itself. Whereas United States, which is a 25 trillion economy, growing by 1.5% means that it's going to add one India in 1 year. So that's the perspective for understanding these numbers. Nevertheless, whether the absolute growth is big or small doesn't make such a difference, whereas where you go, your investments makes a lot of difference as far as market participants are concerned. And therefore, we can always safely assume that since India is the fastest, expected to be the fastest growing country in the next 2 years, for the next 2 years, the markets will also grow in a similar manner. Markets, in fact, usually grow a little faster or a little more than what the GDP grows by, because the market is not just it's a little forward-looking kind of a sentiment. Therefore, the markets can be expected to give you much better returns than what the GDP growth is. So that's one very important thing that one has to keep in mind. RBI has also done some kind of GDP growth and inflation forecast, and RBI comes out with a fan kind of a thing, which says that there's a band here which is from 4.5% to 7.9% band is there for the GDP growth. Says there's a 50% possibility of between 5.2% to 6.8%, and 70% possibility between 5% and 7%, and 90% possibility between 4.5% to 7.9%. So that's the fan chart of GDP growth by RBI, and we have to also look at it from not only not only on a standalone basis, but also we have to look at it along with CPI inflation. Inflation is expected to be anywhere between 6.5% and 3.2% in the next, Q4 24-25 will go all the way up to Q4 24-25. So in the next year, that is. The most likely band seems to be 4.2% to 5.5% again. So the same kind of inflation that we are staring at right now. So expectation from RBI is that inflation will be controlled. In fact, one of the mandates of the Monetary Committee for the last 5 years has been that they call it inflation targeting. So whether it is, there was a time when we used to say that let there be growth and let inflation go to hell. But now we say no, we want growth, but we want to curb inflation too, because we have a large population which gets affected by inflation, even if it goes a little bit here and there. So even at the cost of moderated GDP growth, we are interested in moderating inflation. That is one takeaway from what monetary policy has been talking about. Well, we'll come to the most popular topic these days, that is the political stability for markets to be vibrant. So what are good things that are happening? One good thing that is happening is policies are continuing, because we have a stable government. Stability is there. We don't have we don't have a coalition which pulls in 10 different ways. So therefore, there are no surprises. The government is resolute and on taking decisions in favor of businessmen, in favor of businesses, in favor of the economy. And we are talking about ease of doing business everywhere. We are talking about how we can improve in this ease of doing business index, etc. So basically a conducive atmosphere for running a business in the country. Whereas there are pain points. One pain point that every foreign investor or any entrepreneur would always talk of is the enforceability of contracts. Contracts don't get enforced. There are places where there are loopholes, and there are places where copyrights and patents are not kept in mind, people copy, people. Our patent regime is also a process patent regime, which has been a good boon for us. In fact, as the country, as far as the country is concerned, it has been a great thing, because that is why we have been able to afford medicines. But all said and done, the foreign institutional investors and the foreign uh, investors always look at it from a skeptical point of view, because they think that uh, if you have a loose patent policy or a process patent kind of a policy, then there are chances that they will lose the advantage of having product patents and having super profits, which they have been used to in other countries. Well, and as far as legal delays are concerned, less said the better. There are enough and umpteen uh, examples where legal delays have played havoc with the with investments. As and when uh, there are delays, there are cost overruns. If there are cost overruns, the profitability of a project goes haywire. If the profitability of the project goes haywire, then the stock of that company goes down. And many times there are companies which did not start at all because of the delays. Companies collected money in IPOs, and then there were the project delays, and because of the project delays, the uh, costs went up, they spiraled up, and well, uh, the entrepreneur had to declare himself as bankrupt. That also has happened. So these are some pain points of the in the economy. Uh, Even if we have political stability, this is a great pain point. Another pain point that comes to mind is the statistics. All statistics of organized business is available to you at a click of the button, but that is not all. That is not the entire country, isn't it? That's the whole problem. You can see in the next slide, which will give you a very interesting. Sorry, it will come in the last slide when we look at corporate earnings. Then we will realize that corporate earnings are not the earnings of the country. In other countries, in many in United States of America and things like that, corporate earnings are a substantial part of the earnings of the country. In the sense, they are maybe 70-80% of the earnings can be defined by the country's earning can be defined by the corporate earnings. Whereas here, unorganized, uncorporatized entities, businesses thrive a lot, and they are in fact the bigger drivers of the economy in India. You can see here 40 lakh crores is the revenue of all companies, in the sense all listed companies, around 4,014 companies out of the 4,160 companies listed in the stock exchanges. Their total revenue comes to 40 lakh 36,280 crores with a gross profit of 6.27 lakh crores and a net profit of 3.54 lakh crores. If you look at just the Nifty 50, you find that the total revenue of the Nifty 50 is around 17 lakh crores with a gross profit of 3 lakh crores, around 3 lakh crores, and a net profit of 1.88 lakh crores. Well, large companies, large capital companies, you find that their total earnings is around 25 lakh crores and gross profit of 4.4 crores, net profit of 2.61 crores. Mid-cap companies around 7.88 crores or 7.88 lakh crores, gross profit of around 1.2 lakh crores and net profit of 60,000 crores. Small cap around 5 lakh crores is the revenue, around 63,000 crores is the gross profit, and the net profit of 36,000 crores. If you look at their growth figures, you find that Revenue growth has not been great. It's around 4% for all companies put together, 5.8% for large caps, 7.25% for Nifty listed companies, 6.4% for mid cap companies, and no revenue growth. In fact, negative revenue growth for small cap companies. Whereas, if you look at the gross profit growth, you find that gross profits have been growing at 30%. So basically, it shows that this one small item shows that I think companies in the country are chasing less revenue and more profitability, because you can see here their gross profits growths are in double digits and 30% more than what they were last time. So with 4% increase in sales, if you have 30% increase in gross profit, obviously you are chasing efficiencies rather than chasing sales. Same case with net profit. You can see even small companies, even with their with negative growth in revenue, have been able to achieve 43% growth in gross profit and 42% growth in net profit. These numbers are from moneycontrol.com, available on the website. So this tells us one story that companies have started becoming profitable. Companies have been able to cut down on their expenses, and therefore, if they are able to continue like this, they will really make huge money for the shareholders. So that itself is a great good tiding about corporate growth. And if companies then are able to be so efficient, and when they are able to exploit better opportunities on revenue growth, obviously more revenue would give them much better profits. So hoping that the growth in the economy will result in better revenue growth, maybe 1%, 1 or 2% more revenue growth for all companies put together would make a huge difference to the gross profit growth too. So that's the thinking by which I am going by. That's the thinking that I am going by as far as justifying the investment in Indian companies. So where to invest? Again, these figures easily tell you that the best place to invest is mid-cap stocks, because they are the ones who give you the best kind of gross profit growth and the best kind of net profit growth. Therefore, better return on investments, better return on assets, better return on equity. So large companies have nearly saturated. So even if they have a better revenue growth, they have been the ones which don't have the best of the gross profit and net profit growths. Inefficiencies usually have set into these Nifty 50 companies. You can see it very clearly in the figures. So that said and done, corporate earnings are conducive for investment in mid-cap stocks. We are at 3:45. I need another 5 minutes, just 2 slides more. What are the emerging trends? One trend that you can see in the market is primary market. The primary market is at the peak of its health. You can see here, 2010 onwards, there are these. This data is from 2010 onwards, and you will find that the kind of money that is being raised in 2023, the kind of money that was raised in 2022, the kind of money that was raised in 2021. So 21, 22, 23 all put together, around 2 lakh crores has been raised, and there are 29 IPOs ready for SEBI approval. They have submitted for SEBI approval. for a total amount to be raised of around 33,000 crores in the next, maybe next quarter, not even next quarter, around January, February. So there is huge interest in the IPO market. There's a huge interest in companies wanting to come to the market to raise money. See, companies wanting to come to the market to raise money does not mean that only companies are interested in the money. Companies also have a responsibility of transparency, of governance, and these compel, these regulations compel the companies who come for an IPO to keep their books clean, to have fair practices, to have good governance practices, and play fair. So that reflects on the, not only on the quantity of the economy, it also reflects on the quality of the economic growth. So this is one very positive sign that is happening, positive thing that is happening in the markets today. Okay, so lastly, we come to the we look at the index. I've just put in the graph of the Nifty there. You can see from 1999 onwards, as of today, 21,344 is where the Nifty is. So if you look at what happened in 2020, during the lockdown period, we had gone to something like 7,000, 6,000, 7,000 odd on the Nifty, and from there we have already grown 3 times. So even when indices are at such an all-time high, the PE of the index is not at the all-time high. PE is around 24, 25 or so, whereas the peak of the PE has always been around 28. So there is some room, some headroom for the market to take up. The market participants have always been talking about Nifty at 25,000 and Sensex at something like 80,000, 90,000 and things like that. Some people are already talking about Sensex at 1 lakh. But let's not talk about that. Let's look at a conservative figure of another 10% increase in the market capitalization from here onwards in the next year. Given the different happenings in the market, different things that are happening in the market, like better performing economy, better democratic dividend. Somebody has already put in, I think Kaushika has already put in the chat saying that investment in infrastructure, education, skill development, encouraging startups, all this is part of, all this can happen, all this happens as a dividend of democracy, because, it's not only democracy as well as demography also, because more people are involved in innovation, more people are involved in raising, adding value to the economy, the better things would be. And the diaspora is very much interested in investing. The Indian diaspora across the world is interested in becoming an investor in the country. They are interested in participating in the growth of the country, maybe through mutual funds, through India-oriented mutual funds, through directly investing in India, because today we are at a stage where America was just after the Great Depression. So that's the comparison. Then, of course, increasing efficiency in administration, in government administration, business-friendly environment, and therefore a better performing economy. So this wheel keeps on turning, this wheel keeps on churning. And good news keeps on continuing because this wheel keeps on churning. I think we are at the fag end of We are at 3:50. I think it's time to say thank you, and we are open for questions.
Hello, sir. Good evening, sir. This is Priya Ramkumar from AIMS, sir.
Good evening. Tell me.
Yeah, great session, sir. I'll just
Thank
read
you.
out the questions from the meeting chat. So far, I think you have answered all the.
Yeah, there was one question regarding regarding the investment in skill development, education, infrastructure. Is financial debt of country effect for mutual fund? I don't think so, because see, financial debt of the country basically is the money that is raised by the government for maybe infrastructure or any other expenses, but that will not make any difference to the mutual fund industry. Mutual fund industry looks at what opportunities are available in the market. In fact, mutual fund industry can feed the financial debt of the country, internal debt, because if you and I invest in debt mutual funds, debt oriented mutual funds, or ultra short term mutual funds, government securities kind of mutual funds, then we are also lending to the government. 205 lakh crore debt for a 25 for a 3.3 trillion economy is a very small amount, Salim. So it's not such a big thing. See, what we look at is 89% debt to GDP ratio is what is important. Let's not talk about don't look at what people talk about in politics and things like that. Economically, 89% is a very, very strong debt to GDP ratio. See, when we talk in finance, we say not 2:1 debt equity ratio. So it's not even 2:1, it's not even 1:1. So it's a very good thing. So what is the main fundamental driven factor influence stock market performance according to your experience? Okay, in my experience, I think the one of the biggest driver is the foreign institutional investors who pour in money. And as I said earlier, they are slowly losing relevance, because you can see the earlier Indian investment, institutional investment to foreign institutional investment was 1:15, 1:30. Today we are at 1:3. So slowly we are catching up with them. That means we have our own fuel to run our markets. So now we can say institutional finance, domestic institutions as well as foreign institutional investors are the fundamental drivers of the stock markets.
Thank you so much, sir. It was truly yes, sir. Yeah. One more question?
I think one last question. There is one question which is left. How can investors gauge market sentiment in the Indian stock market?
The Indian stock market is.
Yeah, so see, basically, I would not look at sentiments at all. Sentiments would always be positive, negative, depending upon what happened yesterday, what happened day before yesterday, what's happening in the last 10 days, etc. But if you look at the macro trend, I think it looks good, and one should always look at the macro trend instead of getting into a factor where people look at risks and say, okay, the volume is high, therefore this will happen. The volume is low, open interest is high, open interest is low, kind of thing. Yeah.
So there is one more question. What is the impact of technological advancements like fintech on market
dynamics? And the market dynamics. Market dynamics, yes, I think you can, in your class you would have heard that the most developed financial services market is where there is disintermediation. And fintech will accelerate this disintermediation. Therefore, the cost of transaction will come down. And as cost of transaction goes down, the financial markets will always improve. Their efficiencies will improve. So technological advancement will improve the efficiency like anything. Today we are talking of T+1 settlement. People are talking about T settlement. That is, you buy the share today and evening it is in your account. Mohammed Tahir is asking how to debt, sir. I did not understand this question. Could you please
Yes, sir. Can you just elaborate, sir, the
Can
question?
you elaborate, please?
I think his name is Mohammed Tahir. Mr.
Yeah,
Mohammed
Mohammed
Tahir. Sir, one last question we can have, sir. Or
Yes.
AI tools can affect to stock market.
Yes. AI tools can affect the stock market in future because AI can manipulate. That is possible, and we have to be very, very careful about this new phenomena that is happening. There is, of course, there is a way of fooling the AI also. So, one AI tries to take control of the market, the other AI can always fool that AI. So, there are going to be interesting times. But yes, safety issues are there. Yes, agreed. There are safety issues. There are possibilities that the AI will trick you completely. You can build an AI tool which can trick others. You can build an AI tool which can trick the other AI tool also. A lot of interesting things are happening.
Okay, sir. Thank you. Thank you so much, sir. It was truly an insightful and engaging session, sir.
Thank you.
I appreciate the valuable information and your dynamic presentation.
Parvati Yadav, she says AI will take job from many people. I don't think so. AI is after all artificial. So natural intelligence is always much better than artificial intelligence. It is just AI will take jobs from most people only when AI is capable of doing innovation, and that is not possible. AI is only repeating whatever we do. Human brain is more innovative than any AI. Yeah, people are scared of because suddenly you find that low-paying jobs and low skill jobs can easily be done by AI. So that's where people are scared of. But that I don't think is a worry at all because human beings can always be much better than any computer or any other stupid thing that.
So thank you very much, sir. There is a technical error, so Ramesh.
Not an issue at all, sir. I think he's a little busy with his. He's a very busy man. It's very difficult to catch him that way. Anyway, thank you.
Thank you so much, sir. Thank you.
Thank you.